Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. Joining me is ETF.com's incomparable team of writers and editors, senior ETF analyst Sumit Roy, senior content editor Kent Thune, and contributing editor Ron Day. We have a lot to cover as usual, so let's dive right in. So certain things seem to go together, like Batman and Robin, Abbott and Costello, tension in the Middle East and rising oil prices. Sumit and Kent, you both wrote about the surprising performance of oil this week after Israel and Iran traded missile attacks. What's different this time? Let's start with Sumit.
Yeah, it's interesting because we had all these intense headlines about Israel, Iran, and even the US getting involved in that conflict. And we did see oil increase pretty significantly this month in response to that. So let's zoom out a bit, right? At the start of June, WTI crude oil, it was trading around $60 per barrel. And we ran up all the way to something like $75 per barrel mid-month. So this conflict definitely has had an impact on the oil market. But in a story I wrote earlier this week, I said it's kind of surprising because we're back down to $65 now, right? And you have all these tensions in one of the most important of the world when it comes to oil production, and yet oil is only like $5 higher than where it was at the start of the month. There are reasons for that, right? We're talking about potential supply disruptions, but there hasn't actually been any real supply disruptions. Iran has threatened to close the Strait of Hormuz, but it hasn't done so, and there's questions about whether it could even do so if it wanted to. So I think that's what it ultimately comes down to. We've gotten very scary headlines, but we haven't really had any impact on the actual oil market. And that's why oil prices have come back down. And you have to remember the oil market is well supplied right now. Without these headlines, oil might be much lower than where it is right now. You go back 1 month ago to May, and oil was hitting the lowest level since 21. So this is a market that it's just getting a boost more recently because of geopolitical headlines. And now let me talk a little bit more about, that fundamental picture for oil. The International Energy Agency, every month it publishes this oil market report, and it kind of tries to forecast where supply and demand for oil are headed. And if you look at the latest report, the IEA is saying that demand is forecast to only grow about 720,000 barrels per day in 2025, and it expects a similar level of growth in 2026. Now, compare that to supply growth. The IEA expects supply to grow by a whopping 1.8 million barrels per day in 2025. So 1.8 million barrels per day of supply growth in 2025, but only 720,000 barrels per day of demand growth. So that tells you the extent to which the oil market is oversupplied. And we're expecting more supply growth next year, 1.1 million barrels per day. So given this fundamental picture, that's the reason why oil has quickly come back down. Unless you get some type of supply disruption, either Iran's oil facilities come offline because maybe Israel bombs them. Doesn't look like that's going to happen, in the immediate term. Maybe it'll happen if tensions flare up again, or Iran responds by shutting off the strait. Then you might see actual supply disruptions, and then you might see an actual rally in oil above $100 per barrel or whatever. But we haven't seen that yet, right? Last thing I want to say about this topic is, people invest in oil through ETFs that hold oil futures contracts, right? There's a lot of confusion about what these ETFs actually invest in. The oil futures contracts. You cannot go out there and buy ETFs that hold actual physical barrels of oil. It's impossible. So when you're dealing with futures contracts, there's all sorts of stuff you have to keep in mind. Futures contracts expire. So these ETFs hold a futures contract. They have to sell it before expiration and buy another futures contract. That's called the roll. And what's very important when you're thinking about the role is, what does the shape of the futures curve look like? If futures looking ahead are higher than current spot prices, that's called contango. And if they're lower than current spot prices, that's called backwardation. In general, as an ETF investor in oil futures, you want futures prices to be lower than current prices so you can sell at a higher price and buy at a lower price. And that, in fact, is what has been the shape of the futures curve over the past 3 years. We've been in backwardation, and that's been a huge help for these ETFs. So year to date, you look at an ETF like USO, which holds US oil futures, it's down about 1%, but actual oil is down 8%. So it's been outperforming. And if you go all the way back to 2022, the start of 2022, USO is up 37%, even though oil futures are down 12%. That's a huge gap. And you can essentially make money in oil futures ETFs, even if the price of oil goes down, assuming that the futures curve stays in backwardation. So really pay attention to the shape of the futures curve if you're investing in these ETFs.
Fascinating and really thorough explanation. Thank you, Sumit. So now let's turn to Kent. Kent, with the CFP designation, what is it that you would look at in terms of advising clients and how to strategize to navigate these choppy waters? And what was the ETF strategy that you wrote about recently in relation to all of this that's happening with oil right now?
You've got traders who like to use oil, ETFs like Sumit mentioned, USO. Then you also have what I see on my end, say retired investors or income investors for whatever reason. Energy stocks like Chevron or ExxonMobil are very popular dividend generating stocks. And then you have ETFs that hold those type of stocks. And that would be examples is the Energy Select Sector Spider Fund, the XLE ETF. So you also have not just traders watching oil, but also income investors, retired investors, or their advisors like me. Now, personally, I don't like to recommend energy stocks partly because of this reason, and I can get dividends elsewhere without using energy. But the part of the point I was making with in my article was first on the tradability part. Like Sumit said, I was looking at a timeline. June 11th is when the United States announced that they were evacuating or partial evacuation of U.S. embassies in the Middle East. Okay, traders caught on that. Oil goes up. Next day, Israel attacks Iran. Oil goes up. Then you've got Sunday, United States attacks Iran. Oil spikes up like 6%. And then the next day it's back down. So we went from a price of crude oil from $65 on June 11th at the beginning of my timeline there, and then $65 on June 25th. And as we report this today, Thursday, it's up at 66. So then traders are doing pretty well. And that also goes into what we talked about before, the tradability of Trump. I think traders are buying into that, and what I mean by the fear is overblown on the beginning, and they realize that and know that Trump's just going to pull back right away, like he did with the tariffs. Did the same thing with Iran. So it's really a pattern here. So you can buy on the overblown fear, expecting that Trump's going to chicken out or whatever you want to say. Then you got the price coming back up. All right, now back to income investors or retired investors. It's really just hold on. Do not pay attention to short-term noise. You're not a short-term investor. You're getting your dividend. I looked at XLE. It's right at pretty much the same price at the start of the year, but you're still getting like a 4% yield. And so you're still getting your income. Just don't pay attention to it. That's my advice, is really a lot of the short-term stuff is noise. It's a lot of behavior in trade, but just get your dividend and stop watching the news.
Great advice. Like everything else in life, ETFs continue to evolve and grow from their simple origin 30 years ago. Ron, you wrote a story based on a Morningstar report that raised some eye-opening truths about how quickly the ETF industry has been changing. What's the takeaway for ETF investors?
Well, the ETF investors and industry observers kind of get that this market that we cover is evolving, and it seems like it's really kind of taken a quantum leap over the past few years in terms of the ETF format being so almost like endlessly customizable, right? I mean, it's turning out you can put almost anything. I mean, private equity assets are having kind of a rough time, but almost anything can be turned into an ETF, and issuers are taking advantage of that because the top is all crowded out. The easy picking is already done. All the spider ETFs, the three biggest ETFs control like 17% of the market. I mean, it's an astonishing number. So what this means is that there's this kind of customizability. And what that means is that more ETFs are coming to market holding fewer assets, right? Of course, we have zero. I mean, single stocks are just exploding. And Morningstar's Dan Sotaroff put out a note the other day saying that there is an increasing risk of lower returns as there are fewer assets in your ETF. I guess it's going to mean more fees because people are moving in and out of stuff. But generally, the buy and hold is those have already been picked. And so people are doing more customizable thing. So he's saying, you really got to kick the tires. You have to look under the hood. So the smaller companies, they're picking different strategies.
Let's move on to our special guest this week. Recently, Sumit had an opportunity to chat with Scott Davis, head of ETFs at Capital Group. Let's listen in.
Scott, great to have you on the show.
Thank you for having me.
Absolutely. So really exciting time for the firm. You're launching 3 new ETFs, which I want to get into. But before we delve into that, can you just give our listeners an update on Capital's ETF business? You've now been in the market for, just over 3 years?
That's right. We launched our ETF business 3 years ago in response to advisor demand asking for access to Capital's investment process, but access in the ETF vehicle with the benefits of that ETF vehicle. And so that's exactly what we did. We built an all-active ETF suite designed to serve investors at the core of their portfolios, similar to how Capital Group's American Fund mutual funds have been serving investors in that way for decades. And fast forwarding to today, we now have 22, soon to be 25 ETFs in the United States that range across many categories. We have 12 equity, 9 fixed income across both taxable and municipal, and even have 1 multi-asset balanced ETF. And we've seen strong adoption across platforms. These ETFs are available at most broker dealers and across the major platforms. Assets, we crossed $69 billion in assets. That's all organic growth. We haven't converted any funds. And we're proud that it's a broad diversification of growth with 12 ETFs, all over $1 billion, trading well, giving a great investor experience. And we've even seen some of our funds become the largest active ETFs in their respective categories with strong investor results and flows. Capital Group Dividend Value comes to mind as the largest U.S. large cap value ETF that's active. We've seen similar success with CGGR, our growth ETF, and even CGMU, our intermediate muni ETF. So we're really proud of the growth, and I'd say mostly the adoption from advisors. We have nearly 40,000 advisors who have entrusted their client assets with us, and for that we are extremely proud and grateful.
That's some incredible growth there, Scott. $69 billion in assets under management in just over 3 years. I want to now talk about those 3 new ETFs that you're launching. What are they and how do they differ from your existing 22 US ETFs? And maybe you can also tell us who they're intended for.
Certainly. Since we launched, we've been listening to advisor feedback, wanting to develop ETFs that really meet their demands. So one of the things we've heard from advisors, particularly advisors who are building their portfolios themselves or have a model portfolio framework that they're looking for ETFs to fit within, is to build and design ETF strategies that are more focused and recognize how they're being used within a stricter portfolio construction context. So each of these funds, these three new funds, and I'll go through them in a minute, take a more focused approach to their investment universe. And really, we wanted them to become ideal candidates for those investors who are building portfolios in this way. And they differ a little bit from what we've got today. We have ETFs that fit in a range of investment categories, but they often have a set of flexible guidelines to achieve their investment objectives. But for these three ETFs, 2 equity and 1 fixed income, we have thoughtfully designed investment guidelines that help them fit. And I'll just go through them briefly. Capital Group's U.S. Growth ETF, CGGG, looks at exactly that, focusing on U.S. large cap growth companies. It's benchmarked to the Russell 1000 Growth Index. And so that is effectively its investment universe. And it's seeking to achieve that growth, leveraging our fundamental research and in identifying and investing in those companies that can drive capital appreciation. Capital Group U.S. Value, CGVV, similarly looks at the companies that would fall into the U.S. Russell or the Russell 1000 value benchmark and thinks about how we can invest in those companies to drive capital appreciation in that category, in the U.S. large cap value category. And these are both new strategies to capital, and we're excited to see them serve these needs. We have ETFs that fall in those categories today with broader mandates, but we think these will fit needs of asset allocators looking for these particular services. Lastly, we're launching a fixed income ETF, CGHY, or Capital Group High Yield Bond. And that is going to, again, give a more focused exposure and focused strategy on the high yield corporate investment universe. And that's an investment universe that Capital has deep experience with. We manage $49 billion in those assets today across a range of vehicles. And the foundation of that strategy is all rooted in our fundamental research capability. So we're excited to bring all three of these out. We think they're going to fit well in advisors' portfolios, and we'll continue to listen to advisor needs going forward.
I really appreciate that rundown, Scott. That's great. You mentioned you have 40,000 advisors, I think, using your funds and your products. I find it really interesting. There seems to be a growing use of active ETFs by advisors. Why do you think that is?
Well, I think advisors, particularly independent advisors, have really gravitated towards the ETF vehicle. And, as we look across our book of business, we see broad adoption. We see adoption from RIAs. We see adoption from advisors at larger broker dealers. But I think the common theme is that ETFs fit well in an advisory business model. They are simple from a fee structure. They have a unitary fee structure, so they fit well in a wrap program. Operationally, oftentimes they are fairly straightforward to implement, and particularly RIAs who are taking advantage of platforms where ETFs can be accessed quite easily and integrated into those models that they're building. That operational ease reduces friction. And then lastly, I'd say control and independence. If you think about use of ETFs across the range of investment advisor platforms, and particularly independent platforms, people who are RIAs or independent advisors have a spirit of self-determination and self-reliance and control. And ETFs allow them to control the price and time of execution, for example. And it gives them a better sense of being able to construct portfolios the way they want to serve their clients, and do it with a level of ease and user experience that is very friendly.
Scott, I'm glad I'm talking to you now, because just a few days ago, there was a big milestone in the active ETF space. And that is now, out of the 4,000 plus US listed ETFs that are out there, 51% are now actively managed. They only represent about 10% of the assets, but they're the majority of the number of ETFs that are out there, which I found really interesting. And that brings me to my final question. What other trends are you seeing in the active ETF market?
That's a great question. We could talk about product development. I think that was a tremendous milestone that's been enabled by 5 years ago, the SEC passing Rule 6011. So product development certainly is one theme. Regulatory change would be another. But I think if I'm going to pick one to highlight today, it is one that I see every day and one that is probably impacting more clients than anything, and that's the growth of ETF models. When we think about ETF models, there's a lot of applications, but from issuers to distributors to independent advisors and platforms, we and they are all developing ways of implementing ETFs into models and developing standalone ETF models. And part of that goes back to the, again, ease of implementation, the lack of friction in being able to develop and deploy these in client portfolios, and the fact that models bring tremendous scale, efficiency, and consistency to the client experience. I mean, in one survey we conducted here, we found that nearly 2/3 of the highest growth advisors use models, and they do that because it allows them more time with clients. And ETFs, both active and passive, comprise about half of all model assets today, and that's growing. That last figure was according to Broadridge. But while a lot of those assets are in index ETFs today, we see active growing very rapidly in that space. Active ETF assets have grown from about 2% to 10% of all ETF assets in the past 5 years, and we don't see that slowing down. So I think this integration of active ETFs into models is going to be a continuing theme, and the use of ETF models will grow. And Capital, I just have to say, we launched our all-active Capital Group models in March. That's 8 models across various investment objectives. And we've seen strong interest and platform availability. So I think ETF models is going to be the theme and the trend to watch from here on out.
Fantastic. Well, that's a great place to leave it, Scott. This has been a fantastic discussion. I really want to thank you for your time.
Thank you.
Great interview. Thanks, Sumit. And thanks to all our listeners for streaming or downloading Exchange Traded Fridays. First of all, I'd like to apologize for some of the audio issues that we had this episode. So remember, if you haven't already, please like, subscribe, or follow us wherever you get your podcasts. And if you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. We're off next week to celebrate the birthday of the United States of America. So we'll see you in 2 weeks.